Hello everyone, welcome back to another Lunch and Learn video. I'm your host Mayur Thaker, and today we're going to talk a little bit of a different topic here, taking a break from macro and instead take a look at this little screen that I made. And I'm just calling it the little screen that beats the market, and that's kind of a little play on the book authored by Joel Greenblatt called The Little Book That Beats the Market. But take a look, and I think you might like this one here. So let's take a look at exactly what is in this screen. But just first, a little bit of housekeeping. These views are not necessarily the views of Zacks Investment Research. And of course, past performance is no guarantee of future results. And this material is being provided for informational purposes only. So what are the three criteria? There's only three criteria, by the way. It's a very, very simple screen. And it has had a remarkable track record. I was shocked to see this. Again, back-tested, but still something that is worth taking a look at. So just three criteria. Number one, it has to be a member of the S&P 500. Number two, we're looking at sales growth consistency. Okay, and that's the key word there, consistency. And then the third item is the rate of change in the ROIC. And that's it. That's it. So there's, three factors: S&P 500 member, sales growth, ROIC, and whoops, it's kind of going on its own here, but and that's it. But there's a little bit of a play here as to how we're doing it. So we're talking about sales growth consistency and ROIC rate of change. So that's very important. So let's take a look and kind of dive right into Research Wizard world here. This is a great little tool if you're not if you don't already have access to it. This is our main screening tool, and it's also doubles up as a backtesting tool. This is available as an additional purchase from for if you are a advisor tools client, or if you are a ZRS client. The screener does come included with a ZRS subscription, but if you wanted the 20 plus years of backtesting capability, that would be an add-on. So again, if you are interested in taking a look at these tools, again, we'd love to hear from you. So just shoot us an email, and I'll provide the email address towards the end of this call here. So let's open up the screener that I kind of put together. Just going to click on screen, click on open screen definition, and I'm just going to navigate to my Zacks 51 folder. I'm going to go to inputs, and here is the item that I specifically created. So this is the S&P 500 top ROIC companies. So again, like I mentioned, just three criteria: S&P 500 member, the change in ROI. So that's kind of the rate of change. And the way that this is calculated is that it's looking at the difference between the most recent ROIC, which is net income relative to total debt and total equity over the past 12 months, and looking at the spread of the most recent trailing 12-month figures versus the 5-year average. This is a pre-calculated item within our database. So if you actually go over here to the return on investment section, you'll see we have ROE, we have ROA, and we have ROI. So it's the ROI that I'm using, but more specifically, it's the change in the ROI that I'm using. So it's this last item right here. And what I'm doing here is I'm just saying that we want to pick within the S&P 500 the companies that have the top 30%, that rank in the top 30% based on the change in ROI. Okay, so that's the top 30% from within the 500 of the S&P. And then the next criteria, and the last one really, is the R-squared sales growth. So this is looking at not just the growth rate. In fact, we're not even looking at the growth rate. We're looking at the R-squared in the sales growth. So that's basically a measurement of consistency. And the higher the R-squared, there's only a range of outcomes, and it comes from between 0 to 1. 1 meaning it has a perfect linear relationship. So it grows exactly, according to a linear equation. But most companies typically rank somewhere, between 0.6, 0.7. So if you're in the 0.8 to 0.9 range, that's really at the top end of all companies. So we want very high sales growth consistency over the past 5 years. So the place to get that is under growth. You'll see an option for sales. And here we have the 5-year historical sales growth rate. That's not what I'm screening for, though. I'm using the second item here, which is the R-squared historical sales growth. So again, this is looking at not the growth rate, but the consistency in growth. So the higher this number, the closer to 1 this number, that tells you that this company has very consistent sales growth over the past 5 years. Very steady, very predictable revenue growth. So that's the number that we're looking for here. So we want companies that rank in the top 30% in terms of the change in ROI. And then from that list, we want the top 10 percentile in terms of R-squared sales growth. Okay, so I'm just going to run this so you can see what companies currently pass it. It ends up being just 15 stocks. So it's going to run a very concentrated, a fairly concentrated portfolio here, just 15 companies. It's really 14 actually, because we have Google, both classes of Google in here. So it's actually 14 that are passing. Maybe we can look at, one additional company to make it an even 15. But these are the current companies that pass the screen. These are companies that have had the sort of the largest change in ROIC, meaning the rate of change has deviated from the 5-year average by a positive amount. And these are companies that have had very consistent revenue growth. Look at these numbers here, like Microsoft, of course, one of the greats out there with a perfect R-squared in terms of revenue growth. That's, you can't get better than 1. And pretty much everybody else is within, just 2 basis points from that. So we have MSCI here at 0.98. Again, these are companies that have extraordinary, stickiness with regards to their revenue. And, and that's a great thing to have. These are very desirable characteristics, especially as we talk about entering recession, things like that. Companies that have, very inconsistent revenue, unpredictable revenue, those are the companies that are going to get into trouble. Whereas companies that have had very, very consistent revenue growth, a lot of these companies are just generating recurring revenue, like Adobe, Google, Microsoft, of course, a lot of these software companies, even Netflix, as a subscription service. This is very, very highly sticky recurring revenue. These companies, generate year in and year out. So again, that's very important. But it's very interesting to see that, when you overlay these two together, we want consistency in revenue growth, but also something new has happened. So this is something that's always been the case for 5 years now, where they just have continuous revenue growth year in and year out. But this layer, kind of shows you that these companies are breaking out in terms of their ROIC. So their ROIC over the past year is, breaking out over the 5-year average. So something is happening at these companies that is triggering greater capital efficiency now than at any point in the last 5 years. So that's very important to see. So this adds a little bit of recency and something that's happening at the firm. You can have an increasing ROIC for any number of reasons. One could be that they are benefiting from operating leverage, where they've made investments and now those investments are bearing its fruit. You can also get an increase in ROIC with pricing, power. So any companies that might have raised their prices but are sitting on a very strong moat on their business, so again, pricing power is another important thing that companies can have, especially during inflation. And we know that some of these companies definitely have that, as you can just eyeball and glance at this list. So again, something is happening at these companies in which profitability is increasing. But keep in mind, we're not looking at growth rates at all. This is a very different approach. And I think the reason why this works so well is because we're using different criteria that is often overlooked. Most people don't look at the R squared in revenue growth. They look at growth rates. Most people don't look at the change in ROIC. Actually, most people don't even look at ROIC in general. If you just turn on, any financial media, very few people are talking about returns on invested capital. It's just not something that, gets a lot of airtime. So the change in ROIC gives you a little bit of insight into, increasing margins, or, for a variety of reasons, or increasing operating leverage, or both. So let's take a look at how does this, this strategy perform. This is just the current list, but how has this portfolio performed? So now we're going to go over here to the backtesting section. I'm going to click on backtest, and I'm going to set the holding period to 12 weeks. This is just, an easy way to do it, just because too much, rebalancing is not a good thing, but too few rebalancing is also not good either, because you want to be able to capitalize on changes that have happened when companies report earnings. So I set the holding period equal to just about, quarterly. And I'm going to take this all the way back to 1999. That's the furthest back that this, that our database goes. So this gives us almost, 23 years of historical data. So this gives us essentially an insight into how this strategy performs through the dot-com boom and bust, through the 2000s boom and the 2009 bust, and through the bull market of the 2010s, and through the crazy recession that we got in 2020, and the subsequent bubble market that we had after that. So this will give us a wide variety of exposure to different macroeconomic environments that we've been through over the past 23 years or so, and just give a true idea as to how this strategy performs, or any strategy that you'd like to test. So let's run this, and let's just take a look at what the results would have been if you stuck to this specific strategy for the past 23 years. So again, while those numbers crunch, again, as if you've been watching these videos here, I am an ROIC fanatic. I think our ROIC, return on invested capital, is one of the most important metrics that any investor who considers themselves to be long-term oriented should be incorporating in your overall investment strategy. Companies that produce low ROIC just have underperformed markets, and most academic studies have shown that. So I definitely encourage you to look into incorporating ROIC in your overall investment strategy. And so let's wait for these results to come through. It looks like it's almost done here, moving along. 85%, 90%, 90, and there we are. And check that out here. So this gives us a nice little graphical output on how this strategy performs. You can see that our strategy is in green and the S&P 500 is in red. And you can see that the strategy, crushes the market by 1.5 miles. Now you can see that it's had a huge drawdown year to date, as I would expect, as all, risk assets have really sold off quite dramatically here. And you can tell that, the portfolio has a little bit of a tech bias in it, but that's just right now. If you look at, what kind of companies might have passed in the past, I would think that, these, the results would have been quite different. And yes, you can see that here. Back in this time in August of 2003, you could see that these were the companies that passed, which includes, companies like J&J and Starbucks, Harley Davidson, looks like in here, Walmart. So it hasn't always been, this has not always been a tech heavy, strategy here. So it has evolved over time as companies, change in their growth and ROIC characteristics. But again, this has been a phenomenal performer. You can see that the strategy has delivered a CAGR of 10.4% over this entire 23-year period. That compares to about 6.1% for the S&P over that same time period. and a little bit better of a drawdown as well. The max drawdown of this portfolio is about 45.6%, and the max drawdown for the S&P has been about 51.2%. So better returns, slightly less risk. Wouldn't say by a lot, but slightly less risk. So definitely better returns and less risk. So that definitely leads to, better overall returns and better risk-adjusted returns for this strategy. Now I'm going to take a little bit as sort of a step forward. If this wasn't good enough for you, I've got an even crazier strategy to kind of test out as well. And it uses the same exact criteria, these same 3 criteria, but I just wanted to show you this as well. So I'm going to clear that. I'm going to go back to open screen definition. And I'm going to go to my C drive. I have it stored right here. And it's just, the first one I tested was test 2. And the second one, and this one that I'm doing right now is just my first pass at this. And the only things that are changed are the percentile ranks that we're looking for. So if you recall, the first time we ran that test, we're using the ROIC rate of change to be in the top 30%, and then the R squared to be in the top 10%. Now I've actually ratcheted even more strict. So now we're looking at the top 25 percentile. And then from that, the top 5 percentile in terms of R squared sales growth. So if I run this right here, these are the companies, and it's an even more concentrated portfolio. You're really only going to be getting about 6 or 7 companies each time. So a very, very concentrated list. This could be, a sort of add-on to any existing strategy that you do. So if you are, say, for example, an earning certain, portfolio investor, this could be sort of an additional layer to dial up some more risk. So that's one way of potentially utilizing this. And I fully back this, this overall strategy because it has, 2 of my favorite metrics, as a core component of it. I love consistency in revenue growth, and I love ROIC. So when you combine the 2, this is, a really, really powerful sort of 1-2 punch. So Autodesk passes, Fortinet passes, Microsoft again passes, Verisk, and KLA as well. So these are, again, very interesting companies, and just, very concentrated portfolio. But let's see how this one performs. So it's got even more concentration risk. So one would expect that this outperforms the first one. So let's see if that is the case. So we'll, click on our backtest here and wait for our trusty backtesting engine to do its magic and see exactly what the genie reveals to us here. And voila, and there we go. Huge outperformance here, even bigger and more pronounced than the last one. And if you recall, the CAGR for the last one was about 10%. I think it was 10.4%. Now that's increased to about 12.5% per year in terms of the CAGR. So again, tremendous outperformance, but it does increase the risk, again, as you would expect with increased concentration. So you can see the max drawdown has been about 58% versus 51% for the market. So, it does increase the risk a little bit, but again, I think that risk is warranted given the additional returns that you get from this portfolio. So there we have it. That was my, quick weekly video for this time. Hope you found this interesting. Again, if you wanted access to this specific screen and its criteria that we followed, or if you wanted some more information about the Research Wizard and extended backtesting that we have, again, I'd love to hear from you. If you are a ZRS client, again, please send us an email at zrs@zacks.com. And if you are an Advisor Tools client, please send us an email to zat@zacks.com. All right, thanks everyone, and looking forward to speaking with you again. And if you have any other feedback on how we can improve, how I can improve these presentations, I'd love to hear from you. So again, see you on the next one. Take care, everyone. Bye-bye.